Hello, Leeb Group viewers. Welcome to Leeb, Leeb.com. Today is Wednesday, June 23rd. The year is 2010, and the housing data coming out this week are the latest in a string of really disappointing economic readings. Sales of existing homes in May unexpectedly dropped by 2.2% compared to April, missing the consensus expectation of a 6% gain by a mile. On the bright side, at an annualized rate of 5.66 million units, sales were still up about 19% from May 2009 levels, but it is clear now that the federal tax incentive, which just expired, likely played a larger role in whatever real estate recovery we've seen in the last year than initially believed. Today's new home sales numbers are even worse. In May, the number of new homes sold fell to a record low. Sales plunged a steep 33% to an analyzed pace of 300,000, the fewest since record-keeping began in 1963. To be fair, analysts had expected a drop of 19%, but the actual decline was much worse as home buyer demand fell even deeper than expected without the tax incentive. These most recent data follow poor readings on housing starts and permits issued last week and paint a gloomy picture of where housing may be headed. Beside the housing market, the overall economy is also facing the risk of a double dip. The Economic Cycles Research Institute, ECRI, leading index, as of the week ending June 11th, the latest available data, the growth rate reading in the index has fallen for the sixth consecutive week to a minus 5.7 from 12.7 at the end of April. So a reading in the range of minus 5.7 suggests a real GDP growth rate below 1% on average. So a recession is clearly not out of the question.